Today we're gonna focus on that very weird word called unit economics. Who knows what it means? Or what could it mean? Yeah, you want to give it a try?
Maybe like the costs involved in like making the product like as a single entity.
Exactly. So taking one unit of my product or my service, what are its economics? Like what does it look like to actually sell it? And what are the expenses that are being generated to sell it? Why is this important? Because and I don't remember if we talked about this before, if your product itself is not sustainable, then it's not necessarily scale that will help you make it sustainable. So you need to make sure that the product itself has value. Okay. So for technology businesses, usually there's a big value. For all the manufacturer, usually it's a bit more tricky, because for each new item that I need to produce, I need the machines to be on, I need someone to, I don't know, fold it, cut it. So there are a lot of variable costs that are involved. I need the fabric, I need the box to pack it and send it and all of that, okay? So for all of your businesses, you should now know what are those levers. So what are the revenues that are coming in? And if you have different products or different business segments, they can be different. So for instance, I work at ALX, and what we have as revenues is one, the tuition of the programs. So students come and they pay an amount to participate. Then we do corporate partnerships with big companies. So those companies, they pay for all the programs that we organize. And then we have a membership product. So people pay X amount of dollars per month to be part of that membership. Those are my three business lines, and I'm going to analyze them independently. So for all of you, is it clear, like, what are your business lines? What are your products? For this analysis, I don't use my fixed costs, because I don't care about fixed costs. I just want to know if that unit is being profitable, not if the full business, okay? Because this is the heart of what you're doing. And then all the other fixed costs, you can just work around them. You don't need an office to start off, okay? You can say, okay, no rent, I'll work from home. You might not need all the employees all the time. You might not pay tax in the beginning, okay? So all these things, they shouldn't be part of your reasoning when you think about the dynamics of your business. You should just make sure, is revenue minus cost positive or not? And it sounds very simple, but it's the way to see it. For delivery, and I'm jumping one, for me it's always easier to understand. So GMV means gross merchandise value, which is the total of an order. So for instance, if we take Jumia, the GMV is what the client is paying. So if the client is paying 10,000 shillings for a TV, this includes the price of the this includes everything, the price of the TV and the cost and the price of delivery, and from the moment the person clicks when it's delivered to his door. Okay. But of all this money, it's not all going to Jumia, okay? Because Jumia is not manufacturing the TV. They are making the delivery, but they might not, I don't know, create the boxes. They might not own their payment system. So there are a lot of costs that are being generated there. So of those 10,000 shillings, Jumia needs to think, okay, how much do I need to, how do you say that? What do I need to take away in order for me to have profit? So there's the cost of the delivery, because there's this courier who's using the motorbike. I need to pay that person. Okay. There is the payment system. So when the person pays either via M-Pesa or card on on the website, there's a small commission. Even if it's not a lot, I need to take that off. Okay. Then, what else could be involved that doesn't go to Joomla? Maybe the packaging.
They could have like a warehouse where they store.
Okay.
Producer, they have to pay for storage.
Okay. So if you want to include storage in this, you have to take the cost of your whole storage and divide it by the number of items that you have. Because like in the real world, you don't have storage just for one TV.
Yeah.
They have this big storage, I don't know where it is here. And I don't know if they have 100,000 orders per month, then you divide that total cost by 100,000, so yes. So their contribution margin is this, what the client pays less all those costs that are generated. Which is why their objective is to integrate all those things. Because if I have my own payment system, then I don't have to pay Stripe or M-Pesa or whoever the commission. It's mine. If I have my own couriers, then yes, I still have to pay them, but it's going to be a lot cheaper than if I'm working with Sendy, for instance. If I have my own warehouse that I don't have to rent, then it becomes a lot cheaper. So the more you integrate those elements, the better your profit. But you have to think, is it worth it? If the learning curve to hire 10 couriers and pay them 5 shillings less than what it cost me with Sendy, I'm going to do it with Sendy because they know how to do it and it's less of a pain for me. So it's always about evaluating those things. Okay? Who wants to share, apart from Tracy, like those dynamics of business? So revenues, what are the costs each time I want to deliver or give the client that product or that service, and is it being profitable? There's no good or bad answer. Like, I don't know your businesses, so we have to figure it out together. And when you started, was it the same? Did you have the same cost, or were they higher?
They were lower.
They were lower. Okay.
Yeah, since it's an innovation, so keep on adding stuff.
Okay.
Yeah, so it always goes up.
Okay.
Yeah.
And did your price change?
Yeah, it did change.
Okay.
Yeah.
So that's the thing. Like, you can add, like, your costs can become more important or higher, but you need to make sure that if you are delivering more value, it's reflected in your price. If not, you'll reach a moment where those costs are higher than your revenues and it's just not sustainable anymore. Okay. Which is why increasing prices is not always bad, as long as the value that you are also increasing makes sense for the customer. Okay. So then we'll go into those weird words. So this applies for digital businesses. Okay. Who has a digital business or a part of its business that's digital? If no one, we don't go through that. We can go really quickly. So I'll just explain in case you see it. But there are concepts that apply to all the businesses in general. So the customer acquisition cost is how much does it cost me to acquire one customer. So when the business is not digital, it's very hard to quantify this because it's phone calls, it's meeting with people, you don't really know. When you have a digital business, it's usually what you pay on Facebook or Google, right? So this is like the easiest way to measure it. So I spend an amount for a campaign on Facebook, and depending on the cost per click or the cost per conversion, then this is what it represents, okay? So the objective of those digital businesses is to make it more and more efficient. Okay, I cannot spend the same amount today to promote my business on Facebook than I did 5 months ago. If not, there's something wrong about it. Why? Because 5 months ago, nobody knew me. So of course it cost a lot for those people to find me and then to click. And there were so little people that the conversion was minimum. Okay. Today, there should be 10 or 20 times more people who know me, and I should have adjusted my communication so that they understand better my value proposition, and I target them better. So it's not just, okay, to all the entrepreneurs, here is the course that I'm giving. It's for social entrepreneurs looking to raise capital within the next 3 months. This is a special course on venture capital. Come and join me. Okay. So you become better at communicating your value proposition, and it makes it easier for you to attract customers. Then there's the lifetime value, which is how much does a customer spend on you over a long period. So usually we take 3 years, because for digital businesses, it's the average amount of time that people spend using your products. Let's face it, like even if I was going to use Uber and then I realized that it's been more than 3 years. Going back to Jumia, okay, today I might use Jumia and it might become like my #1 go-to for all the appliances. But the likelihood that in 3 years I'll still use it is very low, because there might be other businesses doing the same things. They might pivot, they might stop their activities, and it just doesn't become that attractive. So 3 years is a good way. And if you manage that over 3 years, it's also really good. So you need to see how much is that person or that client spending over those 3 years. So when I'm selling TVs, if I only sell TVs, it might just be a one-time shot. That's why it's not interesting for Amazon or for Jumia just to sell one category of products. Then growing the business organically, so it's not only for investors, but seeing, okay, if I open 3 more stores, what would it look like? I know that I might have X number amount of new orders or new customers, but the capital expenditure for opening those stores might be too high, so it might not be worth it. So I plug that in my model and see, okay, if I open 3 new branches, this is what it's like. Here's another scenario. If I partner with another distributor who will just distribute my product, I'm going to have the same impact in sales without the expenses. Let's try that out. Okay. So your model should reflect your business, but should also be a tool that you can use. Okay. So that's why I didn't want to go into this with a practical workshop, because it's not about having the most sophisticated model. And investment bankers, consultants do those very fancy things that just stay in a computer or for a presentation. We don't care about that. We want something that we can use on the day-to-day, where we can change the assumptions, where we can change what we think of the business, and directly see what it will look like, and then work towards this objective. So budgeting and forecasting. Then capital allocation. So where should I put the money? Should I put it in expanding? Should I put it in hiring more people? And then valuing a business. So that's linked to the raising capital. But the end question that you always need to ask yourself is, how long is my money going to last? And what milestones will I achieve with this money? That's all. Okay. Because you will have your profit and loss, just as long as it's clear for you. And then you connect it to your beautiful income statement where you have your cost. Same for the cost of goods sold. I'm going to have another tab where I'm going to put all my variable costs. Okay? And it will be linked to those quantities. I sold 2, so it's going to be 100 of my expenses, or 2,000 of my expenses multiplied by 2. And then I linked that to my P&L. Operational expenses, so there are all the fixed costs that I need. Think about these: the material, the machines, the employees, the rent, anything that you need. And your final line should be your EBITDA, so it's earning before interest, tax, depreciation, whatever. I never go beyond that, because for the day-to-day purpose, it doesn't really make sense. Because once again, it's like a useful tool. I don't want to be an accountant. Yes, I care about the taxes, but it's not what's going to change my business. I don't do my business because of the taxes I might pay or not pay. Okay? Then the schedule, so think, what are my milestones? What do I want to reach in 6 months, in 1 year, in 3 years? And then you run the projection. So if your assumptions are well built, if you know basic Excel formulas, and once again we can go into that like on a one-on-one basis, then running the projection is the easiest part. Okay? It's almost like the fun part because you just have to like pull it up. And then the extra thing, which in my opinion doesn't always make sense, is your cash flow statement. So if you want to be like very detailed about will I have enough cash or not, then you can build that, but I think it's completely like then the DCF analysis. So DCF stands for discounted cash flow. What I do with the DCF is that I run those projections on my cash flow, and then I put all those cash flows, so it can be positive or negative, to a present value, because I want to know how much money do I need today to be able to run that business with the needs that I'm projecting. Okay? And this is tied to the amount of money that I want to raise. Okay? So never take a no as the final answer, and always ask for feedback. Okay? It's not about no, we're not going to invest, and you answer like, okay, thank you for your time. No. They need to do the hard work, and when they say no, they need to tell you why, so that you can grow. So it's like this constant feedback. So technology, traction, team, and timing. Okay. Usually the first meetings are never too deep. Have a good pitch deck, well designed with the metrics that you think are important, and give out the information little by little. Okay. Founders who tell me, okay, I can send you a package with my financial model and everything like after the first meeting, I don't want it. But I say no because I'm a good person. Other people will say, yeah, of course, because they can collect all the market data that they want and then make better decisions. Okay. So once again, protect yourself and protect your business. Until you have something signed, you shouldn't give out too much information about your company. Okay, so the instruments to raise money with VCs. So the two most common are this one. The first one is equity. So that's when you define a valuation for your company, say it's worth that amount, and investors can put a smaller amount and they have a stake of that company. So usually this is after Series A. So companies that are a bit more mature in the sense that they already have a business model, they already have sales, so that you can put value to those assets. If you don't have anything, it's a bit hard. That's why there are other mechanisms out there, like the Convertible Note, which is a mechanism a bit like a loan, in the sense that the investor gives you the money, and it will convert to equity, so it will convert to shares of the company when you raise another round. If you don't raise another round, you have to pay back that money with interests. Okay? So usually it's a good way to start off the relationship because it mitigates the risk. Okay? You don't really know what your company is worth, the investor either, but you both want to trust that founder. So let's give it a try. If it doesn't work, the investor can still pull out and he'll still have some money. Okay? And then the safe, it's not used here, it's more in the US, but it works a little bit more like the Convertible Note. How does the valuation work? If you start reading those materials, you'll see that they usually talk about, of course, the amount of the investment, and then either the pre-money or the post-money valuation. It's very easy. Post-money is the value of the company before plus the investment. Pre-money is the value of the company today before receiving any investment. So that can be tricky when you're in negotiation with an investor, because if you don't agree on what valuation you're talking about, it can have a big impact. Because having 10% of a company that is worth 100, if I'm putting $10 million, is not the same as having 10% of a company that is worth 110 million. Okay? So just make it clear, and once it's clear, you can advance in the negotiations. Okay? So it's like, it seems a bit picky, but it's very important. And there are two, like the most important aspects of raising capital is one, the economic aspects. So the amount raised, what is going to be the stake, what happens if the company gets acquired, blah, 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 and the control. Who is in control of what? What are the rights of the investors? And you need to be very aware of that. And if you're ever uncomfortable, or if there's something that you don't understand, ask for advice and have that conversation openly as soon as possible with the investor. Okay? Because there are just too many entrepreneurs who sign things and then things go wrong, and it's like, no, but you should have that part of the equity. This investor has a preference. No, like it should all be clear in the beginning, because the more you raise and the more people you have in your company, the more complex it gets, because all the individuals have different objectives and incentives. Okay, so I'll share that with you so that you can go into it. So once again, for Series Seed and like early stage, think about how much you're raising and how much you want to give out to that investor. Is it 10% of the company? Is it 30%? The qualitative value of the company, so the traction, the technology, and the team. And then Series A and beyond, there's a lot more focus on traction. So how much have you sold? How much have you grown? And revenue multiples, which is more for like larger deals. So if I take again my airline, well, airlines that went public or airlines that are public companies are usually traded without revenue multiples. So the value of the company is 2 times sales, to say something. So you can use this market data to sort of value your company. But this is like in later stages, and with venture capital, it almost never happens because there's not a business that we can refer to compare. Okay? You're all doing things that are completely new or innovative. That's the point of doing it. So it's hard to have a clear comparison.